These are the warning signs flashing across the 2026 market that most investors are completely ignoring. The S&P 500 just printed a record, 7,599. Nvidia is worth $5.4 trillion. And yet the smartest investors on the planet are quietly doing the exact opposite of what your portfolio is probably doing right now. Let me walk you through what is actually happening. Because the gap between the headlines and the reality has rarely been this wide. Start with the number that should make every investor over 45 sit up straight. Sitting at 41.44 as of June 2026, the Shiller-Cape ratio is the valuation metric Robert Shiller built his career on. And that reading puts us within striking distance of the most expensive market in American history. The historical median is 16. The all-time record is 44.2, which means we're knocking on the door of territory only seen at the peak of the dot-com bubble. Trailing 12-month price to earnings comes in at 24.8 against a long-term average of 16.2. And that translates to paying roughly 50% more for every dollar of earnings than investors have historically paid. Wall Street's response to all of this is telling you to buy more. Goldman Sachs just lifted its year-end S&P 500 target to 8,000. Morgan Stanley sees 8,300 by the middle of 2027. And Deutsche Bank, along with JP Morgan Research, are calling for double-digit gains. The consensus rests on one assumption, which is 14 to 16% earnings growth. Goldman specifically projects earnings per share of $340 in 2026, a 24% jump year over year. Here is the problem with that math. The top 10 companies in the S&P 500 now generate nearly 70% of the index's economic profit. Nvidia by itself sits at $5.396 trillion and controls between 85 and 92% of the AI accelerator market. Since the start of 2025, the Magnificent Seven has added $4.8 trillion in value, and 3 of those names are individually worth more than $4 trillion. If you own an S&P 500 index fund, and most of you watching do, you don't really own 500 companies. What you actually hold is a concentrated bet on roughly 10 stocks. Most of them tied to one theme, which is artificial intelligence. The question worth asking is who exactly is nervous about this setup? And the answer should give you pause. Warren Buffett. For one, Berkshire Hathaway closed the first quarter of 2026 with $397.4 billion in cash and short-term treasuries, the highest cash position in the history of his company. Berkshire itself trades at a conservative 14 times earnings, while the rest of the market pays premium prices. And when the man who literally wrote the book on long-term investing parks nearly $400 billion in cash, that isn't a coincidence. That is a message. Michael Burry, the investor who called the 2008 housing crash, disclosed in May that he is running what he described as a significant leverage short position. His exact words were, quote, "For any stocks going parabolic, reduce positions almost entirely." Burry is openly comparing today's AI boom to the dot-com bubble, and the valuation picture backs him up. OpenAI was reportedly valued at $750 billion in 2025, up from $30 billion at the start of that same year, which is a 25-fold increase in a matter of months. GMO, one of the most respected research shops on Wall Street, called private AI valuations the frothiest of all. Then there is Jamie Dimon. Speaking in October of 2025, the CEO of JP Morgan looked at the private credit market and said this, quote, "I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this." The cockroach comment came after 2 high-profile private credit defaults. And by May 2026, the Financial Stability Board had issued a formal warning about private credit is complexity, leverage, and interconnectedness. A $3.4 trillion market, projected to hit $4.9 trillion by 2029. And almost nobody outside of Wall Street is talking about it. That brings me to the second thing most investors are missing, which is that the Federal Reserve is not coming to save you. The Fed funds rate sits at 3.5 to 3.75%. The Fed held at the 29th of April meeting, and JP Morgan Global Research is now saying the next move could actually be a 25 basis point hike instead of a cut. The reason inflation hasn't been beaten brings us to the biggest blindside of 2026. The Iran War. On the 28th of February 2026, join us and Israeli airstrikes hit Iran in an operation that included the assassination of Supreme Leader Ali Khamenei. By the 2nd of March, the Dow had dropped over 400 points. South Korea, S-Kospi fell 12% in a single session, its worst day since 2008. And Pakistan, SKSE 100 logged its largest single-day decline ever at 9.57%. Brent crude rocketed from around $70 to over $110 a barrel within days. And Gulf oil production collapsed by more than 10 million barrels a day by the 12th of March, the largest supply disruption in the history of the global oil market. By the middle of March, California gasoline crossed $5 a gallon, and Goldman Sachs warned that if disruptions persisted, oil at $100 would add 0.8% to global inflation. Qatar's Energy Minister Al-Kawabi warned of $150 oil and what he called a potential collapse of world economies. When asked about rising gas prices, President Trump simply replied, quote, "If they rise, they rise." Think about what that means for your portfolio. Higher oil means stickier inflation. Stickier inflation means the Fed can't cut. No rate cuts means the bond market doesn't rally. And a market priced at a Shiller Cape of 41 has zero margin for disappointment. Here is the part nobody wants to acknowledge. American households are more exposed to the stock market than at any time in recorded history, with Federal Reserve data showing over 45% of household financial assets now sitting in equities, an all-time high. Roughly 50% of all corporate equities and mutual fund shares are owned by the top 1% of households, which means the downside is concentrated on the people who can least afford to be wrong, including a lot of retirees and near retirees watching this video right now. Layer the debt picture on top of all of that. National debt hit $38.86 trillion in February 2026, up 2.64 trillion year over year, and annual interest payments now run around $1 trillion. By 2036, the Peterson Foundation projects that figure climbs to 2.1 trillion. That math forces higher treasury supply, which pressures yields, which pressures stocks. Let me bring this all together. Valuations sit near all-time record highs. Market concentration is at extreme levels. Warren Buffett holds a record cash position. Michael Burry is actively shorting. And Jamie Dimon is warning about cockroaches in a $3.4 trillion private credit market. The Federal Reserve may hike before it cuts. A hot war in the Middle East has already disrupted 20% of global oil supply, and American households are more invested in stocks than at any point in history. Wall Street keeps insisting the S&P is going to 8,000, and they may end up right. Goldman, Morgan Stanley, and JP Morgan are not stupid. But here is the thing about getting blindsided. It doesn't happen when the warning signs are hidden. It happens when the warning signs are everywhere, and people choose not to look at them. The smart money isn't selling everything. Buffett still owns hundreds of billions in stocks, but he is holding $397 billion in cash for a reason. He is keeping dry powder, and he is not chasing a market trading at a Shiller Cape of 41. You don't have to predict a crash to protect yourself. What you do have to do is answer one honest question, which is whether your retirement plan still works if the market drops 30% tomorrow, the level Gary Shilling has publicly warned about. If the answer is no, the time to fix that isn't after it happens. It is right now while the cesspip is still printing record highs and everyone else is still celebrating. That is the truth about 2026 markets. The data sits in plain sight. The biggest investors in the world are positioning for something specific, and the only question left is whether you are too.